Hello, so we're going to talk about the 5 different factors that are either contributed to or are an effect of the Great Recession, and then I'm going to tell you which one I think is the biggest contributor. Okay, so we have our 5 Keynesian aggregate demand graphs that relate to the 5 different factors of the Great Recession that many economists try to argue for. So first of all, we have the housing crash, which is kind of synonymous with the Great Recession, to be honest, but I don't think that's the largest contributor, but I'll talk about that in a minute. So first of all, long story short, the housing market before 2008 was thriving, prices were high, and then interest rates on loans were very low, so a lot of people wanted to cash in on this. A lot of people had 2 or 3 houses because it was so easy to get a loan, and prices were so high, so it was a great investment. But then so many people started buying houses, and so many people didn't really pay their mortgages that mortgages got higher than the value of the actual house. So a lot of people just stopped paying their mortgage or either went bankrupt. Thus, aggregate demand shifts to the left because less people have money, GDP goes down, all that good stuff. And then we have the banking panic, which I think is the reason it all went down. Mostly I blame unethical lending practices, and that's that, but the banking panic happened because banks started lending to people they shouldn't have been lending to, who couldn't afford loans. It's called subprime loaning, and then they would break these subprime loans up, repackage them, trade them with larger banks across the world, and it just got so unstable that when the housing crash happened, they're like, oh no, all the big banks were like, let's stop trading our subprime loans then, and that was what was the banking panic, is banks just stopped trading those loans altogether, and with that, obviously, there's less money going around. And like I said, this instability caused the crash, and the banking panic did not help. And then next we have the Federal Reserve. I drew it, I wanted to show that aggregate demand is still down, but they did attempt to bring it back up with the bank bailout. It was like $700 trillion, I don't know, but they paid banks to not loan, basically. They reimbursed banks, but it wasn't enough, and as you can see, deflation is present, GDP is down. And then we have the food crisis, which I don't honestly think really had anything to do with the housing crash that much. It didn't affect America as much as it did other poorer countries. There was obviously less supply. There was a supply shock. That's why the supply curve is shifted to the left, and prices hiked up, as you can see. Then we have the Affordable Care Act, which I goofed on my paper, and I said that this was a demand thing, when clearly it is a regulation, so of course it's supply. But I argued that now that employers are giving their employees health insurance, there's more money like in the economy, and there's also more demand for doctors and health services, and there's more people employed because they're incentivized to become employed because of health insurance. And also I said that firms could keep wages down if they had to pay for health insurance as well as wages, and that's why I said the demand would shift to the right actually and grow the economy, when really it was actually just a little old supply shock, a big one actually, not a little old one. But the GDP went down, prices went up. The main goal was to give everyone health care, but it didn't work. But it also, I mean, at this point we're out of the recession, so I don't think it's that relevant to worry about. Mostly, I think it was the bank panic, mostly the banks, all the big banks, their fault. And yeah, that's what the Great Recession entailed.